Right. Exactly. Exactly. So before the break, we started to talk a little bit about the bond market. So let's continue on that, because that's, as you said, the bond market's been miserable, but talk about, equities versus bonds and how we think about keeping a balanced portfolio.
Yeah, I mean, absolutely, because that is really the primary conversation I have literally every day now with clients. Because you mentioned before we went to the break a balanced portfolio, and a balanced portfolio should be some mix of stocks and bonds, depending on how risky or safe you want to be. If you want to be safer, you would buy more bonds, whether they're corporate bonds, government bonds, municipal bonds, convertible bonds. Bonds come in all shapes and sizes. And typically, again, 9 out of 10 times, bonds are that safe haven. There's the old axiom: when stock prices go up, bond values go down, and vice versa. The problem, Ron, is not only did the stock market lose faith in the Federal Reserve earlier this year about their ability to control inflation and their ability to raise interest rates quick enough, the bond market lost faith as well. And the bond market sold off at an unprecedented rate. We keep going back to 5 decades ago, and it's the same thing with this. This was the worst bond market we saw since the 80s.
Wow.
And the average bond investment at its low was down about 10 to 11% year to date, which normally a bad bond market is down 2 or 3%. So there really, for the first half of the year, Ron, where really was nowhere to hide.
Hmm.
So my partner and I decided we were going to raise a lot of cash. We were not going to use the bond market because clients would be just as affected. So in our typical model, when we manage for clients, we have between 20 and 25% cash right now, which is a large cash position. It's unprecedented for us because we're also waiting for some signs that the bond market is starting to calm down, which it is right now,
Hmm.
with the Federal Reserve being a little bit more aggressive, with the 10-year Treasury, which seems to be the benchmark that most bond buyers follow,
Right.
starting to level off a little bit. The bond market also has begun to calm down. Now, we have not made back that 11%, and I don't know if we will this year, but that's been a huge part of the problem, Ron, is there's been nowhere to hide this year.
Hmm. Hmm.